Okay. Always check it stops me from signing in. To do about this, and I do not know why it keeps happening.
See, the meeting is automatically set to subscribe.
You know, let me in.
Oh, sorry. That's what the alert was for. There it is.
screen.
Good morning, everyone. Welcome to the Virtual Investment Challenge of 2025, hosted by the IIE. I'm Mohini Pather, and I just want to give you a quick overview of how far we are into the challenge. And then I will hand over to our investment expert, Michael Krobler. We're currently in phase 5 of the challenge, which is where you get your final $500,000 to allocate. This happened yesterday on the 1st of August. So please feel free to use the link that you were emailed. Said it was a link to the trading platform. It is a form where you enter all your trades, and then we'll keep track of them. You should receive your statements later on today or tomorrow. I just unfortunately had my laptop updated, so it's taking me a little while to get everything to work properly again. In the final 2 months of the challenge, you'll be able to do your cash out so that you can maximize your portfolio and sell those holdings into profits. By the 31st of October, we'll stop all trading and we'll calculate the values of everyone's portfolio and see who has made the most profits. Without further ado, let me get out of the way and let our 30-year local veteran of local and global markets teach us a little something about how we can make the best of this investment challenge.
Good morning, everybody.
Okay, can everyone hear me? Okay, welcome back. Right, let me just share this with you. See my screen? Okay.
Okay, so we're going to break up today into 2 parts. First is going to be a little bit of science. Yeah. Okay. The first is going to be a little bit of science, and then the second is going to be a rundown of the very exciting earnings season that we've just had. In America, they have one every 3 months, and it's pandemonium, chaos, adventure, opportunity, emotional experiences. It just smashes you every 3 months. So it's the most marvelous thing to have in your life, because it just gives you it gives you an opportunity to overhaul everything each and every 3 months. Have a look at everything, get updates on all your companies. What are the directors doing? What are their ideas of the future? What are they projecting for the future? They'll talk about all the different things that happened over the last 3 months. Maybe tariffs came into effect, or a war started somewhere, or, any number of things could happen. You could have inflation numbers out. You could have all sorts of stuff going on. So these companies will comment on these matters. They will release financials, and they will release their estimates for the future as well, which has a very big impact on the share price. And they'll also have something called a conference call, where they'll sit and answer questions for the press and for any shareholder. Any shareholder is allowed to come to those meetings. You get an invite. Most people obviously don't go to most of them because they're all over the show. Okay, so we'll do that in the second half, though, because it's like a little bit more fun and less concentration. So in the first half, what we're going to do is, I know you guys, all your lives, you're going to spend some time looking at financial statements, annual statements, and it kind of relates to the second half in that these companies that we're going to talk about in America, particularly because they're applicable to the competition, they have released their financials. So let's talk about what exactly are financials. I'm sure that you've all heard of income statements, balance sheets, and cash flow statements, and it's this whole muck of numbers, and you've probably got a general idea that it starts at revenues, or what we call in South Africa turnover. which is basically just all the money you've gotten from everybody. And then you need to break it down and see what's left over. But it's not just about what's left over, it's about the ratios during the process. So I'm going to try to explain it to you in more of a linear process, particularly the income statement, so you can get a sense of how the later entries on the financials consume the higher entries, and the relationship between how the entries relate to one another tells you a lot about the efficiency of the company. So everybody knows you start at total revenues. We're looking at Amazon now. I picked a share that's obviously quite a successful stock, quite a successful company. And it's going to give you an example of sort of a healthy-ish set of financials. Once you know what a healthy set of financials looks like, you're going to be able to discern between companies you want to invest in the long term that have good economic engines and ones that you don't want to touch. And it might not be obvious at face value, but if you understand how to read financial statements, it'll be very apparent to you very quickly. You can see trends over a period of time. You can see how much money a company is able to extract from its various different ventures. You'll see in cash flow statement, you'll find that companies have more than one way of making money. They can either borrow money, so they can finance, they can also invest, and they can also operate. And different combination of these different income sources is what ultimately drives the company's total revenues and ultimately, therefore, what's left over. So, yeah, you've got Amazon. It was doing only in 2020, it was doing approximately half of the revenue that it's doing now. You can see this basic concept that the company has doubled its revenues in 5 years. Pretty straightforward. Okay. But it's all good and well to have revenues, but what does it cost you to get those revenues? So part of what you need is the actual manufacturing or production cost of the items that you are producing, or alternatively, the service that you are rendering. That leaves you with gross profit. Now, Amazon has quite a large gross profit margin, you can see here, because you've got a company that's turning, it's only costing this section of the revenues to generate all of this profit. You're getting this large amount opened up here. So these guys are in quite a competitive position, because you'll find that companies that are not competing well in the open market, or alternatively are competing in an industry that has tight margins, or for example, manganese, something as commoditized as manganese. We'll have a situation where everybody's making the stuff, so the margins are tight. So, and it costs a fortune to get it out of the ground. So they are being squeezed by the Asian importers, and they're being squeezed by the transporters, the vessels, the trucks, everybody's squeezing them down to a tiny little 5 or 4% profit margin, whereas Amazon has a dominant market position and therefore is able to have a large gross profit margin. Another company with a large gross profit margin is Nvidia, because they're the only people in the world who can make their chips, and everybody needs their chips. So they can pretty much charge whatever they want for it. No one can come around and compete with them for that, particularly for their brand. So brands give you, and competitive advantages and moats and all these terms you've heard, they give you large gross profit margins. It's a very good indication of a company's overarching competitive position in the market. So it's not just about here we have revenues, here we have gross profits. What's the relationship between these two numbers? And what does it indicate? As far as, because here we've got quite a pure version. We're not too specific. We haven't gone into too many specifics. We have just good old fashioned, are they selling more stuff every year? Yes, they are. Is it like a huge spike up and then a crash, then a spike up and a crash? Or is it this sort of consistent upward movement, almost adding at the rate of human population growth times 3, for example, something along those lines, where you've got a really good economic engine just pushing up. Then, so yeah, we've got the revenues are going up. That's great. Okay. But what if the gross profit was flat throughout? You could then see that they were potentially losing some of their competitive advantage. Or alternatively, they were pushing really hard for sales volume increases at the expense of expenses and costs of production. So the relationship between the two histogram bars, as well as the like-for-like bars, as well as the interrelationship between them, can tell you a lot about the company's position in the market competitively. And that was just one line. I mean, it's amazing. So once you've taken away all your really sort of, for example, if you're making, let's say, for example, you were selling steel, then most of your cost of production would be iron ore. So if the iron ore price was rising, your revenues, even if they stayed the same, would have to experience an increase in your cost of production, this section, which would drive your gross profit margin down. A lot of companies are price takers. So a company like ArcelorMittal, the ultimate South African disaster story, because it simply is not competitive on an international basis. It doesn't get to choose the price of what it sells, steel. It's got to sell it at the price steel sells for. And it doesn't have the power to determine the price of iron ore, which is what we need to make steel. So this bar here gets compressed lower. And their growth also gets compressed lower, whereas Amazon is expanding margins. I wonder if this gap here is expanding or contracting relative to this. Tells you a lot about the company. But you can see here that approximately 50% profit margin, gross profit margin, 50% roughly each time. Incredible. Then we have operating profit, which is taking away additional costs in order to achieve the outcome to the customer. Again, you can see that we've got quite a consistent sort of trajectory in all areas. Here you can see they had a bit of a hard time relative to this. There are many reasons why this can happen for this company. They can choose capital, they can choose to allocate capital in different ways, which can keep it out of their financials in order to prevent it from adding to their profits. But the general idea here you can see is that they're obviously a company that increases their revenues, increases their gross profit, maintains a healthy gross profit margin of 50%, and always seems to manage to achieve a fair and recently quite quickly growing operating profit margin. The next line item we'll consider is net income. And this is sort of the bottom line money that they get at the end of the day. Now, what's pretty incredible here is that their net income is basically equivalent or just greater than their operating profit. So in the case of this, they've generated certain profits and then somehow they've generated an additional profit, which is added. So again, you can see that they are converting their operating profit into net income. Net income being net profit. Bottom line on the income statement, bottom line, money at the end of the day. So every time you give Amazon this much revenue to work with, they turn it into this much money. And if you give them this much revenue, they turn it into this much money. So what is the relationship between this purple and this orange? It's probably in the region of 1/10, 1/15, maybe here 1/10. So they're running about a 10% profit margin, maybe a bit more. Net profit on their whole revenue. And you see the flow through of the money, and you can see how consistently they managed to achieve this. This year, 2022, high capex year for them, but the general idea you can see here, definitely a healthy company, probably a bit expensive at the moment, but everything is, I guess. It's probably one of the cheaper of the more expensive stocks, if that makes sense. Okay, so now we've got these metrics telling you about the money that's coming into the business. Okay, basic stuff, all good. What about the debts and the assets of the business? Now we'll move, we won't cover everything in the income statement because really the idea is just the idea that you understand the flow through and that you understand the idea that the relationship between the bars is as important as the absolute movement in the bars, if not much more important. Because it gives you an idea of, I think of it like a heartbeat at the hospital on a sick person who's lying in the bed. That is what these histogram financials are. They're the heartbeats of the company. And if the guy's got a heartbeat that's like all over the show, you know this is on his way out. That if it's looking cool and it's getting stronger every year, this guy's going to live forever. It's pretty much straightforward like that. Let's look at the balance sheet. So the balance sheet of the company holds all equity, debt, and assets. The income statement can be viewed in a linear fashion. It runs from left to right, whereas the balance sheet is a photograph. It doesn't run over a period in the line. It is a snapshot of the company on the day that the balance sheet was created. So you've got a few things in your balance sheet. You've got assets. I'll make this a bit bigger for you. You've got assets. Total assets. You've got total liabilities. And you've got total equity. So Amazon is a machine. And the machine has this many assets on this year. In order to get them, it borrowed this much money, leaving it with this much to use to produce net profits. So Amazon is consistently having higher assets than its debts, which is obviously what you're looking for. Only difference is you'll notice here that the debts constituted maybe 75% of the assets in 2020. Then in 2021, a little bit less. And then in 2022, maybe only 2/3. 2023, we were getting up to almost only half. Now in 2024, we got to half. Look at how the equities rise. And then now we have almost less than half. In fact, the equity in this last financial year is now almost larger than the whole liabilities line. Do you see how much that can tell you about the health of a company? The reason why they call stocks equities is because this bar of equity is what you get. You are buying the difference between the assets and the liabilities of the business, which equals the equity. Now, let's imagine you bought the equity at this price. So on this snapshot, on this day in 2020 December, you bought this equity, this share, at $1, for example. While you own this, next financials to come out, look at the equity. It's gone up. But you bought it there. So now you have this much equity, even though you paid for that much. Then you hold it a little bit longer and your equities in your portfolio will go up because the equity in your equities is going up. Again, you have gone up. This person who bought here, their wealth is rising in the form of equity inside the stock, which emerges inside the stock price. Let's go and look for the stock price. You see, it ultimately follows the rising equity in the shares balance sheet. It will wobble from time to time. And that's the whole idea. Because if you've got a company where, yeah, you can see they created equity from the last set, then they grew their equity and the market was quite happy, sent them up. Boom. But the following year, they didn't grow it as much as they had the previous year, relatively speaking. So the market dumped the stock. Boom. Then they were going to return to considerable equity growth. Smart money realizes this and starts to build a position in the stock. The financials then come out, and it's excellent growth this time. We've almost doubled our equity again. And here we go. And then we go, and up we go, as the trend of equity growth continues. And this guy, smart money Mr. over here, now has his $100 or whatever he put into the stock is about $400 worth. And it's been reflected in the share price. As you can see, Amazon ironically had quite a terrible day on Friday because its actual earnings came out and they were very disappointing to the market. It's one of the stocks we'll cover later. But it's quite funny how that works. So it's this process of sort of following the trend is your friend until the end, till the bend at the end. Okay, so that's the concept of assets and liabilities. Then if we go away from your major variables, we go down to just back to the balance sheet. Then you get total current assets and total current liabilities. What's the difference between total assets and total current assets? The difference is that total current assets are due within the next year. So if they're a big number, you might have a serious problem. And the irony is that you could have a company that has massive amounts of assets, the earlier type, and very few liabilities. But if it had a scenario where it had too many current liabilities and an insufficient volume of current assets, they could still go bankrupt. Or they could go out of business. They could still be salvaged for a net asset value, but the actual operations of the company would fail and the operations would cease because the company is unable to pay its short-term commitments. And if you can't pay your short-term commitments, your long-term commitments don't matter because you're going to stop doing business either way. In the case of Amazon, you have current assets higher than current liabilities, higher than current liabilities, higher, not here, not in that particular set. However, it's back in this set, back in this set, and back in this set. Sometimes a company will, in the short term, borrow money in order to purchase an asset or any number of things. What you're looking for here is they must be consistently relatively close and never have a number that is considerably larger under current liabilities than current assets. There are other things, though, that you can subsidize with. As part of these current assets and as part of the balance sheet, you've got cash, you've got retained earnings, you've got short-term investments, in other words, short-term investments that are so short-term that you could sell them very quickly and they're essentially the same thing as having money. Some things are not the same thing as having money. Like if you wanted to go to McDonald's and buy a hamburger and you had no money anywhere except in the equity in your house, you wouldn't exactly be able to just apportion a section of your house to buy the hamburger. You need money now. Companies most often do not go bankrupt because they have long-term commitments that they can't fulfill or long-term liabilities. 99%, particularly of small businesses, SMMEs, they go bankrupt because they lose control of their short-term cash flow. Oxygen, they can't live without it. They can't pay their payroll of their staff. They destroy the whole morale of the company. They destroy the whole everything of the company. They destroy their relationships with their clients. They breach contracts all over the show. And even though they've got millions of dollars worth of properties all over the show, big farms and all these cool things, it's useless. Your staff don't care about that. Your admin person doesn't care about your farms. They care about getting their salary. Let's say, for example, you do some massive consignment of wheat to a customer and he fails to pay. So you're running a 2 million rand, for example, float in your business that allows you to run the book for the day kind of thing, like a till almost. Think of it like that. If you run out of money at the till, at the Pick n Pay, at all the tills, then no one's going to do any business. Even though Pick n Pay's got millions and millions and millions of rands worth of properties that they own. That's no good to you. Not in the moment. So the best businesses in the entire world are cash flow generative, nimble, not big, powerful. They're cash flow generating monsters that can deal with any storm of any magnitude at any time, 5 different storms at the same time. It's going to happen. So we've got, these are examples of some of the cash items that are available on the balance sheet at any given time. You've got cash and cash equivalents. So that's basically just cash, money markets, that kind of thing, where you can really get it straight away. You've got retained earnings. This is the money that the company has literally saved up. Look at this monster. Gee whiz. These guys really make cash. Retained earnings is a very good indicator of a company's long-term health, its long-term cash generation, and its long-term maintenance of the cash. It's all fair and well to make lots of money, but you have to keep what you kill. Always keep it. You personally should do the same thing. There is no good in making your lots of money. That's not what, like at the end of the day, that's not what determines your wealth. What determines your wealth is how much money you have, how much you kept. These guys keep a heck of a lot. Then we've got short-term investments. They also have some short-term investments. This could be things like fixed accounts or call accounts or notice accounts or any number of different short-term bond holdings in America, corporate debts that are under 3 months, etc. Very easy to get the money. It's always good to have good amounts of cash on hand. Like we could have a 1920s depression anytime, you never know. So you should probably have more on hand than you're expecting. Warren Buffett has like hundreds of billions on hand. Okay. What else can we look at here? Goodwill. Let's go over goodwill because that's a tricky one. So goodwill is horrible to see on the balance sheet, actually. Goodwill is a concept that they thought up in order to ascribe value to things that you buy that are too expensive. So, for example, for the actual net asset value that you're getting. So, for example, if you went and bought Coca-Cola, you would be buying maybe 10% assets, and 90% of it would be the premium that you'd pay to buy the word Coca-Cola. Now, imagine a bunch of accountants trying to figure out how to actually mathematize this concept. How do I, because really they're trying to think of, well, they're put to task by the government who wants taxes. So the government needs to find out how to turn the Coke premium brand ownership abstraction that is what you've just bought, along with a few factories. They need to figure out how to turn it into a number so they can tax you on it. So that they can also ascribe, or they can put the correct number on the balance sheet at any given time in the future as the asset becomes more and less expensive, so that they can give you as shareholder the true reflection of the holding. Okay, so those are your two reasons why we need to have goodwill on the balance sheet. It's got nothing to do with being nice. It's got to do with the fact that they've paid extra for something knowing that they have, because they've bought something that is more than the net asset value of it. So you know the house is worth 5 million rand, but you're willing to pay 15 million rand because Elvis lived there. Exactly the same thing. So with the goodwill, you'll have a company. A good example of a bad goodwill scenario was when Woolworths bought David Jones in Australia. And they paid a great big fat premium for it because it had a lot of brand recognition in Australia at the time. It was a super high growth company. It was really awesome and great. And they were happy to pay, top dollar for it. So when it got allocated to their balance sheet, it was allocated as this big goodwill premium. And then the business just went down the toilet in Australia, literally in about 6 months. So this entire amount of goodwill had to be wiped off the balance sheet. And that causes a tremendous loss in share price. So wherever possible, remember, if you're going to make an investment in the stock market over the long term, particularly, check goodwill on balance sheets. It's always a good habit, because if too much of the asset base of the company, imagine if the company was allocated like of all of its assets, you'll note that goodwill literally sits on, leads up to total assets. So if your goodwill is 90% of your total assets, you could be floating around on a hot air scenario that you could just fall right through the floor, because you wouldn't be talking about factories and assets and cars. You're talking about abstractions. That's what makes up the balance sheet. And you've got to be nervous when you see too much of that. You'll note here that the goodwill on Amazon is 23, and the total assets is 682. So even if the whole story collapsed on everything they own that holds any goodwill valuation, it would barely move their needle. But some shares, it's a massive percentage, 50%, 80%. Then you've got to start going, whoa, 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 whoa. I can't turn that into money. Amazon can turn this, less the 23, into actual money with their assets for the most part. But if you're a 50% goodwill, I mean, you'd have a serious problem getting your money back if the company experienced a problem. Then obviously long-term debt, we can separate it out from total liabilities, because total liabilities can involve many different things. But really what we want to check is, how's the total long-term debt? So let's get rid of cash, short-term, and goodwill, leaving only retained earnings and long-term debt. So company saved this, and this was their long-term debt at the time. Then they managed to save this, and this is their long-term debt. We can see here that long-term debt from 2020 to 2021 went up. It is understandable if a company is growing, and it's acceptable that their long-term debts can grow, as long as you see commensurate rises in other positive metrics, because it's an indication that they are using the debt in a healthy and functional way, and it's not getting out of hand. You don't want the relationship. Yeah, you can see where you've actually got a scenario here in 2021 where retained earnings came down in 2022 versus 21, and debt went up. Not cool. But we were dealing with the whole COVID story here. Then we got back to business in 2023. We had retained earnings up. We had debts down. Big time down, actually. Then retained earnings up, way up, and debt down again. And then another way up, and then down again. So do you see how the direction of these different metrics is just indicative of a healthy business? You've got saved up money rising at an extremely high rate, but not just high, in a consistent rate, which means that, why do we care about consistent? Because consistent is another word for repeatable if you look backwards. So we want to know that they can keep on doing it. If it's a complete crazy show, then you're not sure. These guys are showing you it's a trend of upward increase in savings and downward movement in debt. All right. Let's just look here. Again, we look at the equity. You can see here that this is the portion of the business that is allocated to you as an equity holder. And what a fantastic business this company is. In 5 years, they have increased their equity from 93 billion to 333 billion. And for a company of that size and scale and scope to have done that is a heck of an achievement. These are the kinds of numbers you normally see in a small business that's growing into a new market that's never seen anything like its business before, and it's doing really well, obviously. This doesn't often happen at the scale that Amazon has already reached. It has the growth rate of a young business. Okay, that's all for balance sheet. Let's do cash flow statement. Okay, so we spoke earlier about the fact that there are 3 ways for a company to make money. The first is operating activities. That's doing business, operations. If you're a transport company, it's driving trucks around. If you're Amazon, it's selling books and stuff. Then you get your investing activities. This is quite cool because this is where a little bit of the financial smarts comes in if you're a manager. Because you don't just have to worry about whether your business is selling its product. You need to consider the valuations of the properties and the floating valuations of the assets in your business at any given time. You're also going to be possibly buying businesses and selling businesses that your business may own, and selling assets that your business may own. You also could possibly be buying the stock in your own company on the stock exchange and selling it at a higher price in the future yourself as a company, which companies do. Any of these things that are done successfully add to the profits of the business over and above the operating activities, which is what most people would think of as the primary. It is always the primary source of the income, the operating activities, 99% of the time. Sometimes a company gets like a freak sale of a company and they found a cure for cancer and they just make a fortune, and that's what comprises the largest percentage of the income for the year. But for the most part, obviously, it's usually operating activities. An example of a company where the primary source of income is investing activities is MicroStrategy. Michael Saylor's Bitcoin, so-called Bitcoin, trust that he essentially has small computer software business, which is actually what the company is. And they've got a little bit of revenues, a couple of 100 million in revenues. But 90% of the money that the company sort of works with comes from investing in Bitcoin. The third entry is financing activities. So there's another source of money. You can borrow it. You could also get insurance, issuance of stocks out to the market to give new shares to people. You can also buy shares back again. You could pay off long-term debts. You could get stuff back from old debts. This is in relation to debt, particularly financing activities. and it will be a potential source of income. But again, very much like investing, investing is an expensive process from the company's perspective, and the financing is also expensive from an interest paid perspective. So the majority of earnings, like I said, always comes from operating activities. And for the most part, the investing and financing activities are done as a requirement in order to do business. And they can, as you can see here, their cash flow from investing activities was actually outflow of money, as was their cash flow from financing activities was an outflow of money. And then a large inflow of money, from cash flow from operating activities. Then a little bit of that gets sort of eaten by this one, by this one, and a little bit by this one, and you end up with whatever you're ending up with at the end of the day. Guys, I think we're going to take a bit of a break now for a little while, just to give you a rest until about 11. And then I'll just cover a couple more things here, and then we can start going over the results for the week on the S&P. Hey guys. Okay, we're back. But if you've got your tea, cake. All right, so now I'm going to let you in on some really cool tricks. I'm going to help you forever. This is the stock chart of NVIDIA versus its free cash flows. Doesn't it help to understand? I spoke to you earlier about little companies, little SMEs, little side shops on the corner of the street that need cash flow to survive. Even at the scale of NVIDIA, precisely the same economic rules apply to the corner shop and to the SME and to the normal sized big corporation and to the super corporation. I really cannot express to you how important cash is. Equity is very important, but cash is the result of proper, prudent equity allocation. Because really, you as a manager are responsible for the allocation of the equity of the company. You can give one manager 100 million in equity and they will produce 50 million. Give another manager 100 million in equity, they'll halve the equity, or they'll only produce 10% or something along those lines. So you as a manager or as an asset manager of any kind, whether you're a business or a person or a massive company manager, you're really just using your equity to create cash flow. Now, people will tell you in your life and trading and investing that it's all about this and it's all about that and it's all about this. I'll tell you what it's really about. In the very long term, for the most part, a company's price is determined by its revenues. Because if they continue to rise, there must be fundamentally demand for the company. So the company will ultimately thrive. Even if it has a bad set of managers, they'll eventually be ousted, and this sort of high demand product will continually appreciate in price. But really what it comes down to on a trading basis is two things. Which I'm just going to quickly find in this list of things. Okay, return on equity. And free cash flow per share. If you simply follow these metrics, look, isn't that unbelievable? Look at the stocks chart. Look at the return on equity. People think that companies are based on assets and liabilities and growth rates, and all of that. Really, what all companies are based on, valuation-wise, is the management's ability to allocate the equity. And that is why you can see here that the company's return on equity, this orange line, is the primary driver of the share price's movement. The share price has 50,000 times more nuance to it. But that's because it's plotted on a daily basis, whereas you only get one print of the return on equity per financial set. Furthermore, you can see that this company has a return on equity whereby, I mean, look at these numbers. It's growing its return on equity by 41% per year. Its return on equity here is sitting at numbers of 100%. It is bulking its assets. And then here it had a tiny wobble. One set of financials to the next. One little wobble. This monster, all of its assets, all of its money, all of its positions, all of its brand recognition, all of these trillions and trillions of things that traders sit around and ponder, and think tanks and scientists and PhDs. And they just have to look at this line. That's it. Because all of those things are, they're sub-functions. This is the output of the equation. It is the outcome. If you look at the outcome of something, instead of all the things that happened before, you'll get a much better idea. You know, you've got your friend who tells you how successful and sexy and rich and wonderful he is. And then you look at his life and it's just a joke. How's the outcome? Don't give me stories. How you got to your clever answer. Show me an actual line that has a virtually perfect correlation to the stock price, and then tell me what that line is indicating to me. So this line is indicating to me that this company has management that have a great skill of increasing equity generation over time and the return on that equity. And then when they have their problems, we see it reflected in the share price. Now, a lot of traders were out there, they were doing this whole thing here. Well, up, down, boom, backwards, forwards, like whole fortunes being made here. Guys getting wiped out. And then sideways for like an entire half a year, doing nothing. This person squandered their money. It's just sitting around doing nothing. Then it's a crash. Boom. Really, all that happened was their return on equity went from 119 down to 102. That's really what happened. So all the talk and all the action and all the yakking and thinking and all the nonsense, it's really just emerged into. So you ask yourself, what is the emergent property? What is the outcome? There can be errors in all calculations preceding it. But what if you had this perfect mathematical outcome? Would it matter how we got to it? If I told you 100% of the time, this thing is the main factor, this line considers all variables and amalgamates them into one beautiful outcome, very much like what's called your equity curve on your personal portfolio, which is the performance line of your whole portfolio summarized into one. Those of you, I'm not sure what the interface looks like in the competition itself. But for example, if you have an Easy Equities account, it is the big chart on the front page that tells you whether your money, your net worth has risen or dropped. You can have your friend who tells you about all the cool shares he bought and boom, and he thinks that it did this because of this, and he had this idea that he was going to do this, so he did this. But if you look at the oil price and the inflation rate and Jerome Powell, and you look at Trump, and Trump's such a scumbag, and then there's Putin causing wars and stuff, just say, show me your equity curve, man. Stop talking. This is the equivalent of what return on equity is for a manager's quality. You can't talk around it. If this guy's equity curve is sparking parabolic directly up, I don't care what you say, he's good. If it's crashing down into the toilet, the guy's just not good. He can talk a good game, whatever. He's losing money. You're a loser. These guys know what they're doing. They obviously know what they're doing, and the share price is reflecting it. What you will find here is that in the latest set of financials, which haven't yet been placed onto this website, you will obviously find that the equity, return on equity will move higher here and reflect what has previously happened. Now, who knows what's going to happen in the future? Maybe it will come down. But I promise you the equity curve will come down on the share, the equity price, if the equity return by the directors and the managers drops. Let's look at a company like APPL, Apple. Let's look at the ratios. per share, free cash flow per share. Okay, so Apple has free cash flow per share since 2020. It was absolutely rocketing up back when iPhones were all the thing. Not so much anymore. Their revenues actually did go up this year, but I mean, you can feel it, right? You can feel it in the market that Apples are just not at the point they used to be in a social level. They used to be the biggest thing in the world. So let's check out the stock price. You see? Now the ratios are not the same, so it's pushing it down from an aspect ratio perspective. But if we get rid of, you see how we were going up and now we're going sideways? This chart doesn't have that beautiful upward steep of that vector of that NVIDIA had, because they're not impressing the market with their free cash flow growth. So the market sends the stock sideways because the market doesn't actually care about all this nonsense on the income statement. Because, everyone will tell you, I mean, look at this stuff. Okay, it's great and it's very useful when you're deciding whether you're going to buy the stock or not. You will do an analysis of the financials that takes them very seriously. And then once you've confirmed that this is in fact a valid stock worthy of your investment, or a valid company, let's use the term company worthy of your investment, you will then go to your ratios. You will go and find your stock price. We'll go and find your capital efficiency, the return on equity. You can go and find your cash per share. So you want to get cash per share. Look, do you see? What is this? Return on equity. Now, what is return on equity? Where does it come from? Well, it comes from this whole assortment of interrelationships between the income statement, this quantum process of like a whole bunch of things that are trillions of metrics, variables, and attributes interrelating with one another in the real world to produce these snapshotty numbers on this balance sheet and give you all the debt and the equity and all the story. But it's not actually what the company is worth that makes it change its price. It's what people are doing with what it's worth. There's a distinct difference in that thinking. Take the time to think about it. It's not what's happened in the past that's important. It's right now, what are they doing? The past is an indication of what they could be doing right now. But you have bought it now. You didn't buy it 20 years ago. You need to worry about what are they doing with it now. That's why the market has a tendency of actually measuring the performance of the use of the assets at any given time. That is what determines the valuation of an asset. If I put this asset into a good manager's hands, it is worth more than if I put it into a bad manager's hands. Even though the financials from the perspective that you would be ordinarily taught, the income statement, the balance sheet, those metrics haven't changed if I take consideration of only those. That there would be no valuation change in my mind at a mental accounting level. But if I started thinking about the fact that this company was run by, say, for example, you were looking at this, and I gave you all of Apple's variables, all of their statistical data. Then you would create a little discounted cash flow model and try to be all clever and give me the valuation. Okay. And we knew the return on equity was whatever number it was. Then I told you, okay, they're firing Tim Cook. They've brought Jobs back to life and he's coming back. Whoa, now we know. Return on equity is about to skyrocket. You better believe the share price is going to go up. But nothing here would change if Steve Jobs arrived tomorrow. The income statement wouldn't change. The balance sheet wouldn't change. Nothing would change. But faith in asset extraction would vastly change. You as an asset manager are measured on your ability to crush the water out of the rock. The rock is much less important than how tightly you are capable of squeezing it. And that is what gives companies their valuation. This is why when a guy like Warren Buffett dies, it's such a tragedy to the shareholders, because what's an asset? Who cares? You can get an asset anywhere. A million different versions of an asset. Anyone can buy an asset. If you've got the money, you can have any asset. But you can't get another Warren Buffett. And that's priceless. Time is priceless. Iron ore is not an unrenewable resource, an irrenewable resource. Only time is. Only talent is. Only talent deserves premium. That is how companies are managed. And that is how that is why, a lot of, let's say, some of the individuals in society, they don't like that we pay these managers all this money for these big companies, but the companies wouldn't have the valuations they have if not for the managers. They literally have their valuations because of the managers. And that's why when a Steinhoff happens and everyone loses instant faith in the managers, the share price goes down 90%. Steinhoff had enormous assets at the time, far exceeding the price that the share price dropped to. It still owned PEP, it still owned Taki Town, it still owned billions in real life assets. It had blown its asset base up in terms of valuation, but we were talking about a company that was in hundreds of billions of rands, and even if they wiped off 75% of it, it'd still be worth hundreds of billions of rands. But because the management betrayed us, the stock was wiped out. Because the ability to extract value from the assets was, from the perception of an investment community, wiped out. This is why sentiment is such a powerful thing on markets. Anyway, we've got to move on from this. So I hope you've learned something about financials and how they impact both shares and also how to read them. Because really they are the heartbeat of a company, and if you can learn how to read them like a heart surgeon, then you will be able to stay away from a lot of garbage in your life. And if your friend comes to you one day with that bright idea and he tells you that you need to invest, use this kind of thinking. Think to yourself, am I building an engine of money or a furnace that burns money? Okay, so moving on to a little bit of a different thing now. So this week we had earnings out of a number of companies in America. A lot of you would have been impacted by them. Quite a nice thing about the fact that you've just received this new allotment of 500 grand for the competition is that now that these shares have all released at this perfect time when you've received this money. So now you've got shares that have moved all over the show. Boom. Like crazy movements. For example, PayPal had a 10% down move on the day that it released earnings. Harsh. Okay, so let's go PYPL, PayPal. So let me tell you a funny story, because I actually have all the time I meet people that are starting trading and then I help them out, just on a casual basis. And then intermittently, they'll ask me a few questions, and the one guy comes up to me, it's Etienne, and he says, this is his first ever earnings season. So he's super excited. So he says to me, the one day, and pretty much in disbelief, he comes and asks me, he was under the impression basically that if a company released good earnings, the share price would go up. And if they released bad earnings, the share price would go down. And that your job as a trader was somehow to figure out which ones are going to have good earnings and which ones are going to have bad earnings. Now, that's what most people are taught. It's total nonsense, obviously. Here's why. So PayPal released what's called a triple beat. So versus its estimates, it beat on the revenue line. It made more money than what people were expecting. It beat on the earnings line, the net income, and it beat on the cash flow. So it beat in every metric. It was an outstanding set of financials that then resulted in the share price falling by 10%, leaving my poor friend Etienne pretty flabbergasted by the whole thing. And that's because it's a heck of a lot harder than just figuring out what's going to have good financials and what's going to have bad financials. There's a massive art characteristic to trading, which is about sentiment and what was the perception at the time in reality of the market. Here you can see, we got a one-day chart on our friend PayPal here. It was going strong right up until financials. So everyone had sort of priced in very positive things and all positive stuff. I mean, if you look at this price movement, it's gone up here from 50 up to 70. So think about that in terms of percentage. It's a very large percentage, 20, 30%. And boom, down 10% on this earnings because they'd obviously built up too much positive expectations. And even though the earnings were good, they weren't good enough. So now my friend learns that the market, it's more three-dimensional. It's more complicated than just reading a set of financials, working out what's going to go on. The stuff we spoke about earlier will tell you about the long-term tendencies of the stock. And remember, because it's looking at the financials as they come out at a later stage, it's always backward facing. So it's not going to protect you from this kind of movement on a stock. But it'll give you the best stocks to buy for the long term. Then as a trader, you've got to come in with sort of a different mindset. You've got to work out, all right, now I've got to deal with short-term volatility on my long-term good stocks. So our poor friends there at PayPal, they went badly south, even though their earnings were good. Then we have Microsoft. Okay. It also released earnings this week, MSFT, and its earnings beat expectations, right? But check this out. It's a trick. So you're on this epic upside trend. Yeah, it's just no problem for like ages, since May. Then the company releases financials last week, and the share price pumps like 10% up, huge, 8%. And then as it pumps, it dumps. And everybody who bought the pump gets crushed. So again, it's not just about buying good companies that have money coming in, and the next set of financials will hopefully be better than the last. And if they are, they'll put forward a good number, and the market will, like a perfect system, just send your asset higher. No, there are 1,000 things that can happen with new information. Always remember, action creates information in your life personally, in the stock market. if you don't know what to do, you're stuck in a rut, you literally have no idea what to do, just do something. New information will come to light that will be a good enough reason for you to have done what you did, even if what you were doing was pointless. Similar thing happens here. Gives you a starting point, gives you something to work with where there was nothing before. So these guys took the information that they had, they took action, and boom, they got new information. Unfortunately, it taught them a lesson, but they got new information. The other guys who bought, PayPal, they got it wrong for completely different reasons. Both of these groups got it wrong. These guys actually got the move right, but they didn't get the follow through right. The other guys on PayPal, they didn't get the move right or the follow through. Maybe we can find something that didn't actually crush everybody. Well, before we do that, let's look at UPS. Another one that crushed everybody. So UPS came out with not very good earnings, and it got crushed. So it's not to say that if you release bad earnings, you'll go up. You can also get crushed. A lot of crushing around. But the idea is that there's many ways that the market can take earnings. So it's not this like sort of immutable law that you will have a scenario where if shares have great financials, they'll go up. There's a lot of other things going on that can cause the stocks to move in a way that one wouldn't necessarily predict would be the right way. Robinhood is a company that released great financials, absolutely outstandingly good financials. The share price then went up on those financials. And then they went straight down afterwards. But they took a day or two. So there you had a little bit more of an opportunity to make the best of it. It released earlier in the week, so it released here, boom. You had some time, and again, down, then up and down. So you can see there's a lot of movement happening as a result of the earnings that you're seeing. The companies are busy. The share traders and the investors, I should say, are busy pricing in this new information. Probably the success for the week as far as earnings outcome was Meta. Meta actually did really great on their earnings announcement. It was this movement. The only reason why they came down here like this is because yesterday was an absolutely shocking day on the stock market in America broadly. But they held most of their gains. So this one, you would have said that anyone who went long or bought the share before the earnings, because they were of the view that Meta was a good company, they would have been proven right. But they are like 1 out of 4 examples we've discussed. And all of the people were probably right. It's just not how it works sometimes that you actually make money out of being right. So they say in the market, you're either right or you're rich. We had a number of other companies out. Coinbase was a complete disaster. That one came out, it's the crypto trading company. They hold a lot of crypto for people that aren't in wallets, sort of a safer way theoretically, although everybody gets hacked these days. You had Amazon come out, was a complete disaster. It was the worst performing share on the US stock exchange yesterday, on Friday. Its earnings came out on Thursday after the close. Remember that in America, some shares will issue their statement before the open, and some will issue it after the market closes. So why did Apple crash on Friday? Because it released after the close on Thursday. So if you had Apple shares that you wanted to sell after you saw the financials, you couldn't have sold them on Thursday. You wouldn't have had the information yet. But at 12:01 at night or 11:01 at night in our time, they would have closed their stock market and the info would have come out, boom. And now if you want to sell Apple, you've got to dump it on Friday. You'll recognize a lot of these companies. Kraft Heinz also came out with financials. This is a food company in America. Robinhood, like I said, came out with great financials, but yeah, it just seems like these companies couldn't really hold the gains because on the Friday, it was an absolute shocker of a day on the market in America. Nucor is a large steel manufacturer in America. It came out with its financials. Procter and Gamble, you'll know the company provides many of the products in our homes. Merck, medical, vaccinations, that kind of thing. UPS, transport, Boeing came out with earnings. Sophie is probably not one that you would have seen on your accessible stocks because it's too small, but it's a popular one for America. United Health earnings came out. This was an absolute story of the week. Probably comfortably the cheapest stock in the Dow at the moment. Metas were excellent. Microsoft's were excellent. But, the funny thing was these two here, actually, here's an interesting fact. Okay, so just try to comprehend this. Wrap your brains around this fact. You see here on Wednesday after the close, Meta and Microsoft released their earnings. Then there's a futures market that projects how much those stocks will rise by the following day as a result of their after close earnings results. If you combined, so they both did about 10% in the aftermarket. So 10% of Microsoft moving up by, okay, and 10% Meta. Market valuation at the moment, the assets of the business, the actual market cap of the company, going up by 10%. This one and this one, 10%. You take those two 10%, you put them together. They were larger than the entire European stock market. Just the combined 10% moves. That is how high value. Now, whether high value means worth lots of money or very expensive, these two companies are, it's up to you. But such is the extent of the power of these moves now that we have reached on this incredible stock market that we've been in. This is the NASDAQ. And NASDAQ has, it's funny, it's truly beautiful actually that you have received this new money in your portfolios as you have been presented something of a discount, as you can see. So the stock market was going up very strongly for a very long time. Very strong. And then earnings week happened here. Earnings week is actually about 3 or 4 weeks, but it obviously occurred over this recent period. Make this a daily. Here you can see every candle is represented by one day. Every candle represents one day. So the last few weeks would have been sort of, few days. And then as earnings season gets to the hot stuff at the end here with the big companies, because they save the best for last, boom, market gets just vaporized. Yesterday was a stinker of a day for the market. So it's pretty extraordinary how you can see some of my process charts just to give you an idea of the market moving out of this range. And as terrible as this horrible move was, it's represented only by that microscopic little red dot there. So you can only imagine what can happen if this happens. So people, be very careful with your new money. The reason why I'm showing you this particular chart at this particular time when you are at this point in the competition is, don't go blow it all now. This market is not cheap. You're going to have to be quite stock specific. Be careful not to buy stocks that have run very hard of late. They are the ones who are suffering the most now. So, let's see. You can see here, it was a bit of a bloodbath yesterday. Nvidia, Apple, Meta, Amazon. Just so you know, this is called a heat map. And it's the term used to describe this form of image. You can see that it's got all of the different sectors of shares in America segregated from one another. You can then see by the quantum of the sector, you can see that Nvidia is the largest company, and Meta is smaller than Nvidia, and Apple is almost the same size as Nvidia. And Broadcom is, or you could say Broadcom plus Apple equals Nvidia, or Google plus Meta equals Microsoft. That gives you an idea of how to scale it. And it'll blow your mind actually how there's Tesla compared to Nvidia. No comparison, right? Even though Tesla's gigantic. Look at McDonald's compared to Tesla. You wouldn't think that, eh? Look at Walmart versus Amazon. Walmart used to be the big deal. Now Amazon's Charlie's whole breakfast and his lunch and his supper. JP Morgan, the world's biggest investment bank. Berkshire Hathaway, Warren Buffett's company. This is Eli Lilly. Johnson & Johnson. Procter & Gamble. All American companies. This is CVS. Here's Netflix. Look how big Netflix is. It's pretty huge. IBM. Check out these tickers. General Electric. Look, for example, at the size of Nvidia versus AMD. Adobe. And many of you will have heard of Palantir, the computer security company that does a lot of government contracts. Cool stuff. So make use of heat maps if you want to see sort of how the market did for the day. It's pretty cool. It just gives you a summary and a snapshot. The whole idea is that the reason why I show you about the financials, all that stuff, is because you got to be careful with analysis paralysis in these kinds of sciences that we have here, because you can spend your life on the art, you can spend your life in the psychology, you can spend your life on the mathematics, the statistics, the finance, the economics, the macro, the politics. It's about usable, worthwhile information. That's why I show you this, for example, with the return on equity. That's a usable piece of information. You can use it for the rest of your life. You can use it to buy stock successfully for the rest of your entire life, just knowing that one little thing. Even if you don't know anything about stocks and you've never gone to stock school, never went to business school, all the thinking people will sit and think about all the things they think about. And you'll look at one line And some of them will think about what they think about, and they'll get the right idea, and they'll end up doing what you do anyway. But you could have just looked at the line, and they could have as well. And it doesn't matter how smart they are, or well educated, or well funded, or advantaged, or whatever. You can just look at the same line. This is the true egalitarian nature of the stock market, is that if you educate yourself only to see useful information, no one can ever have an advantage over you, because one thing's for sure, there's so much information and it's free. I'm not paying for a single service on this entire thing I've shown you. I don't pay for services. I educated myself. And now I look at all the free information, and I simply cherry pick the things I know to be real life, practically applicable truths, actionable facts, laws of mathematics. That's what you've got to spend your time trying to figure out. Once you've got that set of things, you'll only need to look at 3 or 4 things, and you'll be completely sure you know what you're talking about. Also, because you are of the view that you are in fact working with the final product, the opinion of others will become irrelevant. And while in real life it's very important to consider the opinion of others, in markets it's just not that clever, because the other people are pretty stupid most of the time, especially when they get together. A person can be clever, but people are almost always stupid when they work together in a large mass group. So, yeah, I think we'll stop it there, guys. You get the general idea. It's been a heck of a fun week. I'll just quickly let's just quickly get this one for you. So this one that we're looking at now is this week's earnings. And I'm just quickly getting for you. Okay. Then this one is next week's earnings. So you're very welcome to screenshot this. I'd make use of it. Remember the before open and after close aspect to them. You've got some serious big boys here. Palantir, Hims and Hers. You guys will know about these shares. DuPont, massive. BP, British Petroleum. Caterpillar, Pfizer, huge pharmaceutical company. AMD, Supermicro Computer, Astrolabs, Arista, Open Door. This share went up about 1,000% in a week last week. Incredible. Snap, you'll know all these companies. Rivian, Electric Vehicles, McDonald's, Walt Disney, Novo Nordisk, Oscar Health, IonQ. This thing was the best performing stock in the world last year. AppLovin, another one. Uber, Shopify, Eli Lilly, Soundhound, Celsius Energy Drink, Trade Desk, Pinterest, Sony, Wendy's, Tempus. You know these companies. Just remember, take advantage of the knowledge that these companies are releasing. It might influence what you are planning to do, or at very least when you were planning to do it. Keep it in mind. Duke Energy is another one. You can see here they're going to have quite a big Tuesday and Wednesday, and then the earnings sort of start to die out. These companies are smaller. ConocoPhillips, they're big, but they're not that big. Here you've got like Walt Disney, Novo Nordisk, Medical, AMD, decent sized ones. Okay, guys, cool. God bless you, and God bless you, and have a wonderful weekend and a wonderful earnings week. It's going to be fun.
Hi guys. Okay, so Rook, do you have a question? I saw your hand was raised.
Hi, Yohoni.
Hi.
So thank you for the meeting today. I just wanted to say we are from IIE, and me and my friend we started a bit late from because of a misunderstanding. So I just wanted to ask, where can we start from? Because we did.
So I don't know if your mic is unmuted.
Hello. Can you hear me?
I can hear you.
Okay. Oh,
Can
sorry.
hear. Yeah, continue.
Okay, so I just wanted to ask where to start from. Like I know we are investing because we have 500K and stuff like that.
Are you talking about in terms of the competition where to start?
Yes.
Okay, so you've got certain number of shares that you're able to choose from. You're
Okay.
aware of which shares those are? The
No.
Dow constituents?
No.
I think you need to possibly look through the original material that Megan sent out when the competition
So we only
commenced.
received 2 forms so far. That's all.
Maybe we can just get you, in touch with her on email, get you the original information, make sure that you've got everything. And then you can
Okay.
still capitalize now. I'm sure that there are people that may have started in the competition in the beginning. That's all fair and well, but maybe they're down. So you might
Okay.
actually have an advantage over a lot of
Yes,
people,
yes.
even if you start now, especially since the market's just experienced a drop. So don't worry so much about the fact that you started late. As long as you start, it's a lot like actual investing. Best day
Yes,
to plant a
yes.
tree 10 years ago, second best is today.
Yes,
So
absolutely.
you can do that very thing. And I'm sure Megan will just get in touch with you and absolutely she'll help you get started on what instruments you can choose from. Then I'd suggest
Okay.
you watch the videos because the second video that we did was a detailed rundown of all of the different shares that you can buy in the competition with charts and everything. So that should be enough to get you started. Really, it should.
Okay, thank you so much.
No problem. Go crush them.
Thank you.
Cool.
Thank
Okay,
you.
sure.
Bye.
Okay, Rook, sorry if you're still here as well. This is the share trading platform or the purchase platform. Okay, so all you're going to do is put in your student number, your name, confirmation email. Okay, I don't want to actually corrupt the system, but then you'll choose your investment philosophy. Okay, so the first video that we released this year was about these different trading philosophies. So are you looking for a company that's currently undervalued and that you're hoping that the market's going to push it higher? Value investing, fundamental analysis, that's where you're looking at the financial statements. Are you looking at technical analysis where you skew towards charting, or a quantitative investing strategy? That's where you're again looking at the numbers. Or are you taking a sustainable, responsible investing route? It's not a particularly popular one, but we have to include it. Okay. Okay, here is where you will choose the share that you would like to purchase. Okay, so we've given you a list of the Dow 30 shares. Okay, so these are the biggest shares in America. And the reason we've chosen the Dow this year is so that we can give you an opportunity to trade on the American market in a very reasonable fashion, because they move much faster and much higher than our local stock market, the JSE, which we've done in previous years. Okay, and then finally, you'll be choosing how much money you'd like to invest. Okay, so here you have your 50,000, 100,000, 150,000, 200. Obviously, if you want to invest the entire lot, you can still do it in allotments. Just process all on the same day. But as Michael has previously mentioned, it's a better strategy to, even if you're going to buy the same share, perhaps wait for, release of earnings, or maybe start investing in that share at, before the earnings are released, and then capitalize once you have more information, that type of thing. But it's a very simple form. And then once you submit it, I have a system that's built in SharePoint. It's very simple that will then process your trade and send you out a confirmation at that share price. So we look at the
Okay.
day that you put the trade into the system, and then it calculates based on the closing price of the day. Okay, so then you'll receive an email from us. Yesterday, I also sent out your new investment tracker. So there you'll see on your, see if I can just open that as well. Okay, so on your portfolio tracker sheet, here are your different shares, still the shares, the same list that you're provided with that you can purchase. If you choose any of the shares, you can choose the amount of shares that you've bought, again, will be confirmed by email, and the amount of money that you have invested. Okay, so how much did you purchase? Say you purchased 200,000. Okay. It will pull the current price of the company and show you what your profit or loss would be. Okay. It shows you the change the company has experienced in the day. It'll show you the percentage change, how your portfolio has been allocated. So what percentage of your portfolio has been allocated to each share, and the value of your purchase at the moment. Okay. So you can choose any of the shares here, and then you just adjust this to reflect your actual portfolio, your trades. Okay, and then if you need any further support with that, you can just drop me an email. It does sometimes take me about 24 hours to 48 hours to respond. I'm sorry. We do have about 500 participants this year, but our active traders have made our leading trader. I will send out your statement later on, but they've made about 90,000 rands in profit, the leaders. There's still 3 months left of the competition. There's still a lot that can happen, especially in this market. So, like Michael said, I think you guys have every opportunity of still crushing it.
Okay, thank you so much, Mohini. I just wanted to see where to start from. Thank you so much for the help.
Oh, no, absolutely, Tanya. All the best. I'm sure you'll do very well. And if nothing else, we'll just keep providing you with materials so that you can take all the skills that you learn here and then compete next year or try trading yourself. Like Michael mentioned earlier, Easy Equities is a fantastic platform to just start trading, even if you just start with like a demo account, just so that you can hone your skills, definitely win it next year.
Thank you.
You've got a big advantage in life as far as your actual age goes as well. So the competition is a fleeting thing, but in real life, you have the unrenewable resource. You have time. So you'll have a huge advantage over the people that you encounter later in your life if you commence now. Even if you do it as slow as a tortoise, you'll still be way ahead of them by the end, because just to start will immediately, that's an action you're taking, and it's going to invite an enormous amount of new information that you will then be able to process through in your life and think which direction I'm going to go. It'll give you the ability to invest in real world events. It'll give you the ability to take action in ways you never imagined, to capitalize, to be a true capitalist.
And one last thing, sorry, just to close off. I have to say, I've done master's level finance, and you never have the opportunity to actually apply your knowledge. So everything you learn during your BCom and your business degrees, that you so rarely, until you're in the business environment, so we teach you conceptually about these different concepts in business and finance and accounting and marketing, and then you only actually get to apply it when you're in a job. But this gives you real world overview, CEO level understanding of how your financials and how all of these things you learned are really applied in the real world. And it gives you an actual advantage being able to generate passive income and be able to talk with about these massive companies with such a wealth of knowledge behind you. So I think, just joining today, just participating, and honestly, I think you guys, you don't even realize the advantage you have, and I'm so proud of you from a lecturer perspective. And I hope you have a wonderful weekend. God bless, and all the best for the rest of the competition.
Cheers, guys. Well done. You're in the 1%.
Thank you.
Bye-bye.